Hey there, everybody. Very nice to see you on this weekend webinar experience. Thanks so much for coming along. If you have questions as we go through the information, please ask anytime. You can use the question area, the question panel or window or pane that GoToWebinar provides, and we'll keep an eye on that. And we're going to take time to answer every question today because we think it's important that you have access to that kind of information. We're delighted to be able to share with you today some information about the MAX trading system, and in particular the wonderful upgrades that have been provided to the training that we offer in that system. The use of the enhanced trade format indicator and its companion indicator, which helps us to know the bias, directional bias for the trades. These two things work together in a tremendous fashion and have made a huge difference to our training. So if this is your first exposure to MAX, you've come along at a very, very good time, and you'll be very excited about the possibilities that you'll see today. Chris is here along with Eusebio, and we're just thrilled that you're participating and want to help you in any way that we can. It's important, we think, to have a system that is not only reliable, but one that inspires confidence in your trading, and also one that is very flexible, allowing you to choose the time frame of your preference, the time frame that works for you and for your schedule, and also works extremely well in any market. If you prefer futures or stocks or options or commodities or Forex, any of these things will work very well with the MAX trading system. Eusebio is a wonderful trader, highly skilled, also a very good teacher, and we think he's absolutely the best person to share with you an overview of the MAX trading system. And then Chris will have some additional information for you. And as I said, please be sure to ask questions as we go along. Eusebio, it's a pleasure to give this group to you, and will you share with us the MAX trading system?
Thanks, Craig. Thank you for your introduction, and it will be a pleasure indeed to show the trading system. So before starting, let me be sure that you see correctly my screen and you hear me well. Would you like to type a yes or a Y in the question area of the GoToWebinar? Oh, thanks, Dilip, Corny. So I suppose, and I see on our private room also some journal. Okay, thank you very much. So, well, just before describing what the MAX is, let me give you a very, very small background who I am. So my name is Eusebio. Eusebio is my first name, and I like people use my first name to call me. I am a Belgian and live in Belgium and France, now essentially in France, and I am a full-time trader since 2008. But I have a long experience in different financial markets, more than 30 years experience in trading and investing in stock market, options, futures, and since 2000 in the Forex. I am a former software engineer, and I have worked as a services manager for big customers in Europe, and among them, during the 15 years of my professional career in the IT industry with banks, important banks in Europe, and this has given me the opportunity to know several traders in these banks and to see how they trade and try to understand some of their approaches to invest their currencies and to manage their position in the market depending on the different events which may happen in the market and can change the value of each currencies. So what I'm going to present essentially is the MAX ETF trading system. ETF is the new name of the MAX trading system because we have added two new concepts I will describe in a moment, at least one of them. And then I will illustrate several of these concepts with some examples. And if we have time, I will touch a word about the money management we have with the MAX and what this can produce. And if we have time at the end of the presentation, I can show you some charts on our MetaTrader platform. So if we have time. So a small history of the max trading system first. The max trading system has been created by late Dr. Jim Pruitt, known as Tiger by his student, and we have been set to lose him in 2009, mid-2009. And the aim of Jim was to give the traders, he had as students, a very powerful but reliable and also flexible trading method. And I like to use the word method instead of systems, because indeed the MAX is an entire methodology which takes into account a lot of things through some concept and rules to define when we have a trade opportunity and when we have to close the trade. So even if the MAX is based on very simple concept, it's not so easy to learn and to apply. There are two important keys which are very important to develop or to acquire in order to become successful with the MAX trading system. And this is true also with any other serious trading system, by the way. Work and commitment. The MAX contains a lot of points. It's a complete trading system. And so because trading is not an easy task, I am always against any trader or so trader claiming that the trading must stay simple. It's not true. Trading is complex. When we trade with or against the best traders around the world. And so trading is not easy. It requires work to assimilate all the concepts, all the ideas, all the philosophy, and all the rules, and then to apply them correctly. And in order to sustain that important effort we have to invest in, a big commitment is important too. And so you need to develop such a commitment. If your commitment is only to make money, which is, by the way, one of the objectives in trading, but if your commitment is only making money, you will not succeed. You need to have a way stronger commitment in order to justify and to sustain that important effort you will have to do in order to master such a trading system. But there are also other skills or keys to develop to be successful: discipline, patience, persistence, concentration, confidence, and I like to add also conviction, discipline. I have said that the MAX is based on concept and rules. We have to apply these rules with discipline. Applying the rules is the discipline without never deviating from the rule. There is one exception. We can sometimes deviate from the rules when we have a reason to do that. And this is a complex subject I teach in the MAX Advanced course, for example, and I call discretionary situation. What is a discretionary situation and how we can handle it without destroying the philosophy of the MAX. Patience. Because we have rules, in fact, a rule depends or is a set of conditions we want to see fulfilled before applying a decision associated to that rules. And so we need to wait for all these conditions to be fulfilled. And so patience is necessary before taking an action. Persistence. Persistence is also a very important aspect in trading. I see many traders who do not hesitate to jump from one system to another system, hoping to find the holy grail after 2 or 3 losing trade in a row. If you do that, you completely ignore the realities of trading. Making 3 losing trades in a row is nothing. Making 5 losing trades in a row is nothing. You need to know what are the losing streaks you may face when you are trading with a trading system for which you know its winning rate, for example. For example, do you know that even if you have an 80% winning system, without defining here its reward to risk ratio, but if you have an 80% winning rate system, you may still face losing streaks made of 4 to 10 losing trades in a row. And so if you jump from one system to another after 3 losing trades in a row, you completely ignore these realities in trading. Concentration. I have said that the MAX is made of many rules and a lot of details to take into consideration in order to understand what is happening in the market. And so when we trade, it's important to concentrate on what is happening. Confidence. Confidence is a very important aspect because in trading there is also a psychological aspect, and these psychological aspects come essentially from the fears we may develop when we trade. We have the fear to lose money, we have the fear to be wrong, we have the fear to be successful sometimes, we have the fear to miss some good opportunities, and a way to overcome these different fears is to develop several levels of confidence. And by levels of confidence, I mean, first of all, confidence in the market itself. When you scroll through charts, many pairs, many time frames during a large period of time, you will see that the market gives you opportunities after opportunity. Opportunities are never missing. There is never a lack of opportunity. So you need to develop that confidence in the market itself. Then confidence in the max trading system itself, especially by studying its concept, its rules, and then by learning, applying them correctly. And so that confidence in the max comes from practicing, in the first step, the max. And then confidence in yourself. You are not alone when you will learn the max. You are surrounded by the max team. And the aim of the max team is to help you to understand correctly and apply correctly what the max is, in such a way that you will develop that confidence in yourself. This is another aspect in overcoming the psychological problem traders may have in trading. And so these levels of confidence is a very strong way to overcome all these psych problems. So, and in that order, in order to define a trading method, we want to go through several steps when we define the max. And this is something I have always found strange when I have studied in the past some other trading system. For example, I have never seen, or not very often, the definition of the movement that trading system was claiming to trade. For me, it makes sense to define the movements we want to trade. How do we define trends? If our max trading system is supposed to trade trends, what do we call a trend? We then have to define how and when a trend can start. And so we will define for that setups. And setups are simply different sets of conditions allowing to say, okay, now we have the possibility for a trend to start. We have then to define when these setups are valid to take a trade. And we have three types of validation. We have a technical validation. The max is based on indicators and some other tools. But we have also a risk validation, because we can never trade without knowing the risk, without assessing the risk we take when we open a trade, and how to adjust the risk when the trade is evolving. But there is not only the risk on the trade, but also other type of risk. For example, the global context of the market may present an important risk, telling us that it is perhaps better to skip the trade. And so the global context is also very important. And so we have these three levels of validations before opening the trade corresponding to one of these setups. We have several setups. And then we have to define how to handle the trade while the trade is open, in order, first of all, to reduce and then cancel the risk. When the risk is completely cancelled, this means that when the trade becomes a risk-free trade, then we can consider to optimize the profit we can extract from that trade. And so the first priority of a max trader will be always, always, always to consider to handle the risk and not the profit. Focusing, first of all, on the profit is often one of the reasons why many traders are failing, ignoring the risk, especially the risk at the beginning of the trade. And then we have to define also how a trend, or as I will call them later, a directional movement, can exhaust. We can never be sure 100% when a trend comes to an end, but we can have a good idea when a trend is exhausting. An exhaustion may be followed by a trend reversal, or it may be followed by a trend resumption sometimes later. But when the trend exhausts, it's a good point generally to close the trade, because we optimize also the time we want to stay involved in a trade. And so I will define here two levels of the max. The historical max, as Tiger has defined the max, created and defined the max, and then the ETF, the max ETF. And so first of all, the historical max. The max, max is an acronym which stands for three concepts. The M stands for momentum. Indeed, we want to open a trade only if we see enough momentum and also enough volatility in the movement we want to trade, either at the beginning of the trend or later along the trend. The A stands for acceleration. And the acceleration here means a scaling process we apply in order to progressively build a larger position by adding to the trade under the appropriate conditions, of course, in order to increase the profits we can extract from the trend we are trading when we close the trade. And so this scaling process is an important aspect of the max, and it must be while we have a strict control on the risk we have for the trade. Because, of course, if we don't pay attention, adding to a trade will increase the risk of the new position we obtain. And so we have to control that risk. And so there are specific conditions to be able to scale in. And then the X stands for exit. And we will have two types of exit: partial exit or scale out, as some traders call them, and total exit, when we have to close the trade because we estimate, for example, that the movement is exhausting. And so the max and the historical max or classical max, but also the max ETF, is so essentially a trend following method. In the past, with the classical max, we had also some ways in upper level of the max advanced and further, to trade also counter trend movement and some types of consolidation area. But now we have generalized all these concepts with the max ETF. And so with the max, we have also a very strict trade risk management and also a very solid money management approach. And as Craig has just mentioned a few moments ago, the max can be applied to any time frames and to any market. I will not repeat the market he has mentioned. If it is important to understand what the max is, it is also important to understand what the max is not. The max is not a scalping method. We are not interested in trying to catch just a few pips in the shortest period of time. We consider that as retail traders, we are not well armed to scalp the market. The max is not a news trading method. We don't try to catch these important spikes we have sometimes when we have an important news release with a big surprise, because these spikes, first of all, are very fast, and we have sometimes a big latency with our brokers, and we have also an important spread widening, which makes our order executions always bad. And so we don't try to trade the news, but we can trade, of course, the movement following a news release once the market has assimilated the meaning of the release. And the max is not an elementary buy and sell system. We will have different types of entries and different ways to make our entries depending on the market conditions. We don't make an entry, we don't open a trade when the market is trending or when the market is ranging, for example. We have to adjust to the market conditions. And so I have said that an entry setup is a set of conditions in order to define, in fact, what are opportunities. And as I have mentioned, I will just repeat here, an opportunity will be based on three aspects: the technical aspect, the risk conditions, and the global context. And similarly, in a similar way or in a parallel way, we will describe the exit setups as a set of conditions defining when we have a risk in the position we are holding. We do not try to predict what the price will do or what the price should do or could do. No, we try to quantify the risk at some point along the trade, and if that risk quantification tells us that the risk is important enough, we have to consider reducing that risk by several types of actions. for example, by making a scale out. And our exit setup, we have several types of exit setup. Some of them are based on technical indicators and the pattern they are exhibiting. Some of them are based on pure price action. Some of them are based as a combination between technical indicators and price action. We call them hybrid exit technique. Some of them are based on purely timing aspect. For example, if we are in a trade and we are facing a news release, we have to close the trade before the news release. And we have also the concept of movement invalidation, or also I should have completed here trend reversal, because when we are the aim is to stay in a trade as much as possible, as long as the trend is valid. But if that trend reverses, we have to consider closing the corresponding trade and possibly open a trade in the new trend direction. When we use the max classical or historical approach, these last years we have been facing some challenges several days. And this is true with any trading system, especially in the small time frames. We may have, for example, and I will show in a moment what I mean by that, very poor price action or very small price movement. When we don't have a movement in the market, and if our trading system is a trend following system, it's really difficult to make some profits. Sometimes when the price reacts very fast, we can miss some ample and nice price movements. When we use indicators, all the entry technique based on these indicators may sometimes be problematic under some market conditions, because as you know, the indicators are lagging and sometimes they may have a lack of reactivity. I like to make the distinction of both, because lagging and having a lack of reactivity is not the same. Even if generally a lagging indicator is not necessarily problematic, because we don't strictly define our entries based on the behavior on the indicator. An indicator is simply a tool which makes us easier or faster to pinpoint some interesting situations in the market. And then I have personally felt always frustrated to be forced to make the distinction between a trend and a counter trend. Sometimes we can see a very ample movement made, first of all with a counter trend portion and then continued with another trend portion. But for me, it has always been an entire movement. And this is what we have tried to solve with the MAX ETF. And also with the MAX, we use essentially time bar charts. And a time bar chart is simply a conventional way to decompose the time, and so the price movement. And we may sometimes miss details in the price movement, in fact. And so, let me just show one of the first point, a decrease in the momentum and in the volatility through years, especially these last years. If you remember, in 2008, with the subprime crisis, we have seen an important momentum and volatility. That was really huge. But since then, we have seen that regularly a decrease in the momentum and the volatility. The two charts I'm representing here, one on the euro-US dollar, one on the pound-US dollar, but this is true for any pairs, is the average daily range and its evolution over time. And we can see that for the moment, we are at a very low level of the average daily range. And the average daily range is a combination of momentum and volatility, not only volatility, but it is also cyclical in nature. So we will see somewhere in the future an increase of the average daily range. But when we have small average daily range, then it's way more difficult to trade with a trend following system. This is true also with other cross. For example, here I show the euro kiwi or I show the pound yen, and we see exactly the same type of behavior. And so what we have tried to make with the MAX is how can we improve the MAX in order to easily overcome all the challenges I have mentioned previously, and especially the situation when we have smaller average daily ranges, in order to keep the features of the MAX trading system as a trend following system, but which can be adapted to smaller movement conditions. And this is when we have introduced the ETF concept, which means extended or enhanced trading format, with its companion indicator, which is a directional bias indicator I will illustrate in a moment, in order to trade many more movements. Many of these movements were not tradable with the max, the classical max, to trade larger movement, and so to recombine into one unique movement when this happens, counter trend and trend movement into one unique directional momentum movement. And when we have first of all introduced that ETF concept, I think it was 2 years ago, we have made it completely separated from the max primer and the max standard, which are our two first level of the max, in a separate higher level of the max, but we have decided recently to include that ETF concept as a basic concept, a fundamental concept in all the level of the max, and so especially in the max primer and in the max standard. This is why now we call these two level of the course the max ETF primer and the max ETF standard. Of course, to try to make you understand the differences between the classical historical max trading system and the max ETF trading system, let me show you these two approaches through some examples. So let me take my red spot here. Here I consider it was a few days ago a movement, a directional movement, a typical directional movement in a pair. The pair is not important. It was, by the way, the Euro Kiwi in the 5-minute time frame here. And at some point here we have seen a down movement. And when we consider the trades along that down movement, we can see the following differences between the classical max primer and the max ETF primer. All the trades made with the max primer are notated in white. And so here we have, for example, what we call a BO-REMO is an entry setup, in this case to go short at this point. We had all the conditions to open a short trade at this point, and then with a stop loss on this place, and then once in the movement we were able to handle the trade, and especially here at this point, exactly here, when you see MX1, MX1 is a partial exit. Whenever we open a trade with the position sizing concept, we calculate the size of that trade, of course, but we consider the trade is made of 2 units. It may be 2 lots, it may be 10 micro lots, it depends on the size of the trading account, in fact. 2 units because when we have to consider an MX, a momentum exit or a minor exit, we will close 1 unit. And we keep 1 unit as an open unit for the next exit. And later on here, on this point exactly, we have another set of conditions telling us to close the second unit. And so we have, and the final close is called an XXX. And so on that entire down movement, we had only 1 trade with the max primer with 1 entry, 1 MX, 1 XXX. The first and the second unit have got a total of 88 pips, 43 plus 45. So this means 44 pips on average, because we have to divide the sum of the 2 units by 2 to have the global trade. And then if we divide by the size of the stop loss, we have the rework to risk ratio, the realized rework to risk ratio, which is 1.76 R. I like to use the R notation of Von Tarp. R represents the risk. And so, for example, if the risk we take on that trade is 2% of the account, this means that that trade has made a profit of 2% times 1.76, or 3.5% approximately. This trade has increased the trading account by 3.5% approximately, with a 2% risk. Now, with the max ETF primer, the aim of which is to catch larger movement, redefining what we call a directional movement. In fact, we have an earlier entry here. using these two new lines we call the ETF lines, and so and the companion indicator, of course. And so we have been able to open the trade earlier, and we have the same MX and the same XXX. And so because we have been able to open the trade earlier, the result of the first trade is larger than with the max primer, and the increase in the profit is important. We see here 106 pips instead of 88 pips. But there is another advantage. With the max primer we had a stop loss of 25 pips. With the max ETF primer we have generally a smaller stop loss, 19 pips in this case. And this contributes to increase, importantly, the reward to risk ratio, 2.79 R instead of 1.76. Not exactly the double, but a good increase. But it's not the only benefit we have from the max ETF primer. Later in the same movement, while with the max primer we were not able to open a second trade, with the max ETF primer we have been able to open a second trade here. We call an ETF REMO. This is another set of conditions, so another name. An MX here, and then the XXX here, so another trade, not a big trade, a 19 pips trade, but with a small stop loss, 20 pips, giving an almost half R reward to risk ratio. And so that entire movement, having lasted a few hours, 3 or 4 hours approximately, so 2 trades for a total reward to risk ratio of 3 point and almost a quarter R. This means that with a risk of 2%, this means a profit on the account of 6.5%, 6.5% on just one trade with no risk at all in that trade. Now, of course, we have also the max standard, and with the max standard, we have the scaling approach. Now, let me show you that scaling approach, because this makes a big difference. So we have, again, in white, all the steps made with the classical or historical max standard, and in yellow all the steps made with the max ETF standard. Let me illustrate first of all the classical max standard. We have the same entry as previously with the max primer, of course, the breakout REMO here. And then on this point we have a first scaling. At this point we add to the trade. If you remember, I have said whenever we open a trade, we consider the trade is made of 2 units. When we add to a trade, we add 2 additional units having the same size. But a few bars later, 2 bars later, in fact, we have been forced to close 1 unit. So we have opened 2 units here, 2 units here, we close, sorry, here, and we close 1 unit here. A few bars later, we are able to add a second scale-in, then to close a unit here, then to close another unit here, and then to make another scale-in, close 1 unit here, close 1 unit here, and then the final exit here. We had reason to close the trade here. And so we had 1 initial entry, 1, 2, 3 scale-ins, and 5 scale-out plus the final exit, for a total result of 234 pips, representing a reward to risk ratio of 4.68 R. So a nice increase compared to the max primer, whatever the level of the max primer. But with the max ETF standard, because we have been able to open the trade earlier like previously, and to make an earlier scale-in, we have 1 additional scale-in. So 1 initial entry, 1 scale-in, the same MX here, the same scale-in here, another scale-in, another MX, MX, scale-in, MX, 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 and the final XXX on the same place. The profit is even larger, and by 100 pips approximately. And because we have also a smaller stop loss as previously, the increase in the reward to risk ratio is really important, almost the double of the max standard. And we multiply by several times the reward to risk ratio of the max primer, classical or ETF. And so you see here the benefit of using the ETF concept, which redefine in another way what we call the directional movement. We redefine in another way the trends, which help us to increase, to have many more opportunities and to increase the result. Now, what is that companion indicator I have mentioned a few moments ago? Let me retake my red spot. It is this indicator. It is made of 2 lines. One green line, one red line. The red line is a short-term bias, a fast bias, in fact, and the green line is a slow bias or a long-term bias. And this long-term bias tells us when the trend reverses and when to stay in a trend. For example, here we can see that we have a trend reversal having started in this area. But we have taken the first, we can take a first trade here. We can take a first trade here, of course, but I have considered a trade here after the Tokyo Open with a specific entry setup we have. And we can see through the bias indicator that we could have stayed in that movement all along until this point, possibly until this point. But here until this point, because we have rules telling us when a trend may possibly exhaust when we use a combination of the slow bias with the fast bias. And in fact, with this vertical line here on this blue bar, we had the exhaustion of that movement. But because of the number of units we had, we have been forced to close our trade before the exhaustion or the reversal of the trade. We have opened 2 units here with a stop loss of 24 pips. We have made an MX here. We have made a scale-in here. And sorry, if we compare the classical max primer and the max ETF primer, in white we have again the max classical primer. So one entry here, an MX scale-in, the final exit. You see the result. With the max ETF primer, we have an entry, an MX, an XXX, so we have one first trade, a second trade here with the entry here with a small stop loss, 17 pips, an MX, an XXX, so 2 trades instead of 1. And so you can see an increase by almost 2 of the reward to risk ratio. And with the max ETF, we could have been also able to trade that uptrend due to the fact that now the bias was upward until this point here where we could have switched again to a short trade. Now this same movement with the max standard and the max ETF standard gives something a bit different, and as you can guess, larger profits. So with the max standard we would have opened the trade here. There was no scaling. The trade was exactly the same as the max primer. So with the same result, you see here 135, 135. But with the ETF standard, and because we were able to open the trade earlier here, we have been able to make several scaling. It was one unique movement with several scaling, several MX. One initial entry, a scaling, an MX, a scaling, an MX, a scaling, an MX here, an MX, and then the final XXX, which was exactly on this point here. And so you can see the difference of the result, a result 3 times larger than with the classical standard, so for a nice 5R result, a 10% increase with a risk of 2%. And again, so the bias indicator was is of course the same. So that bias indicator helps us to stay in a trend as much as possible. This was in the 5-minute time frame, but it is true in any time frame, and I have here just an example with the daily time frame. It was on the pound Aussie a few weeks ago. With the max primer, we had no trade at all. This is an example when in this up movement we had no possibility to have a max primer trade, but with the classical max standard, we had one trade here. So with the max primer, no trade. With the classical max standard, only one trade here. This is the trend portion of this entire movement. This is defined as a counter trend movement. This is defined as a trend movement. So here we had a small trade with a small reward to risk ratio. But now let's see how that up movement can be handled with the max ETF. It is on the next slide here. And so here now we have something completely different. In white, again, we have the max ETF primer, and in yellow, the max ETF standard. I will not describe all the steps here. In white, so the max ETF primer, in yellow, the max ETF standard. So with the max ETF primer, we would have been able to make 2 trades, the first one starting here and ending here, and the second one as in the max standard, the classical max standard. So you see the result, the two trades, 2.72 hours. This up movement can be considered as a unique movement with the max ETF standard, with several scale-ins and several scale-out. In fact, we have had 4 scale-in, 4 MX before the final close, and this trade with the max ETF standard has produced a nice 7.28 R, so almost 15% profit using a 2% risk for the trade. Don't be impressed by the number of pips. We are in the daily time frame. We never pay attention to the number of pips we make. It's just for an indication, but way more important is the reward to risk ratio. And you see the difference between the classical max primer and standard compared to the classical, to the ETF primer and the ETF standard. So we have really improved our way of trading, and you can see again how nicely our trend bias indicator has worked nicely. So pinpointing in this area the trend reversal right at the bottom of the movement, and pinpointing in this area, in fact right on this point here, this stop, allowing to open short trade around this area, not exactly on the top. It's almost impossible to pinpoint the lowest low and the highest low of a trend, but we could have exploited that down movement very early after the trend reversal. And on this point, look here, we see here a deep pullback the price is making, but our bias indicator was telling to us that that pullback was not important. We had to stay in the trend, in that trend, and indeed a few bars later the downtrend has resumed nicely, allowing to catch another very important profit in that down movement with one or several scale-ins. So, of course, we don't have 100% winning trade. We have losing trade. The main feature of the max, because we pay attention to the trade risk management, is whenever we have a losing trade, the loss will be always small. Let me show you a typical example of the losing trade here. At this point, for example, we had the possibility to open a new short trade at this point here, but the price has reversed against us, making a deeper pullback, not invalidating the downtrend, but a deeper pullback. But when we see a deep pullback, we never know how far the price can go against us. And so it's better through the trade risk management to close the trade with a small loss before attempting another trade. And so here, as soon as the trade has been opened, the price went against us. We have been forced to close one unit here following our rules, and then the second unit on this point. But you can observe before the stop loss has been hit. And so the loss is a very small loss. It's not minus 46R. I have not corrected that slide. It is minus 0.46R, so just a little less than 1/2 R. So this means that with a 2% risk for the trade, a loss of a little less than 1%, which never hurts an account when we have such a loss. And we have approximately 15 to 20% of losing trade, approximately 70 to 75 winning trades, and the other trades are break-even trades. I have mentioned that we have, with the max, a very flexible way to trade the different market conditions. We define several types of what we call price modes, which reflect the market conditions. And we define what we call a trend mode, a counter-trend mode, a consolidation zone mode, for which we have to make the distinction between a large consolidation zone and a tight consolidation zone or a squeeze. And then we have a choppy mode. Specific version of the choppy mode is even called a spaghetti zone, but here the choppy mode is behavior in the price market. When the price exhibits a complete erratic behavior, we have no regularity at all. In the max course, we define exactly how to pinpoint a choppy mode, of course, but the beauty of the max is when we have recognized a choppy mode after that portion of the chart here, we have very few valid setups. And so we are not forced to take many trades, waiting for the price to leave the choppy mode. And so we have very few trades. And so because we have very few trades in the choppy market, we have the choice either to skip it or to take it. But if we decide to take a trade in a choppy mode, we have to handle the trade in a very careful way in order to optimize the reward to risk ratio we can extract, which will be by nature, as long as the price stays in the choppy mode, a small profit or a small loss, by the way, because we don't always have a winning trade even in a choppy mode. And so this is the way we define the features of a movement. How can we avoid trades which may be bad trades? This is why we define these different price modes. In terms of money management, so I will not make the insult of explaining what is the concept of compounding the result. You know that compounding the result or capitalizing the result is a way to grow an account very fast. It has been described by Einstein as the eighth discovery in the world, one of the most powerful phenomena in the world. Let me just say you something. You may have this spreadsheet allowing you to make some projection, depending on what kind of result you are making, what kind of objective you have. If you want to double, for example, your trading account, how many days it will take you for that. But let me just show you just one thing. If you are able to trade every day with a small time frame, which is a strong assumption, by the way. Now, don't get me wrong, just to give you an idea. If you are able to trade every day and to make every day an average result of 0.5%, 0.5%, with one or several trades, your final result at the end of the day is 0.5% on average. At the end of the year, you multiply your account by 3. If you are able to make a 1% profit on average every day, which is not necessarily easy because some days you may have a loss. But if you are able to make on average 1% per day, and if you trade every day, at the end of the year, you multiply your account by 10 approximately. So this is the power of compounding your result. But it's not easy, as I have mentioned, and for all the reasons I have just explained. But this gives you an idea of what you can achieve once you get consistency in your trading approach. And so now, in terms of courses, the max courses are organized in 5 levels. The Max ETF Primer. Chris will give you a little more information about the Max ETF Primer. Then we have the Max ETF Lite course, which gives more possibilities compared to the Max Primer. Then our flagship course is the Max ETF Standard course. Chris will also mention a few words about that. So the presentation, the proposal we make to you today is the Primer and the Standard. Then we have also the Max Advanced course, where I teach more advanced concept, taking into account a more global aspect of the market and the different markets, by the way, in order to better understand what is happening in the market and to better choose the trade we want to consider. And the final level is the Max ETF SAM. The ETF is the concept allowing us to catch many more movements, many more opportunities to catch larger movement. So because we make earlier entries and better exit. The SAM is another concept we have added in the Max 4 years ago, and which allows to go in more details in the price movement itself. And so fine-tuning our way to handle a trade. And so in conclusion, and I will stop here, so with the Max ETF, whatever the level you will consider, you have a trading methodology which is based on sound concept and strong concept, and in the different level of the courses we explain why these concepts work in relationship with the behavior of the big boys who move the market. And during the training we always put the focus, we attach a lot of importance to the fact that even if we use indicators, we don't trade the indicator. The indicators are simply tools allowing us to go faster, to pinpoint interesting situations in terms of trade opportunities or in terms of risky situations, forcing us to take a decision to reduce that risk. But in definitive, it's always the price action which tells us what to do. So we have a very solid string trading method with a sound trade risk management and money management techniques. And so, as you have understood, we always put our first priority on the trade risk management. We want to, first of all, reduce the risk or cancel the risk. This is always our first priority before considering the profit we can extract from the trade. And so we want to develop your personal confidence through different activities we have around the MAX, so the coaching, mentorship, the homework. Chris will describe a little more the homework and the practice sessions we have, and so the workshop we have, the forum we have, and so on. So this is what I wanted to explain to you about the MAX ETF. I have tried to show through some example how powerful it is. And so if you have questions, feel free to put them in the question area. And so now it's my great pleasure to give the mic to my friend Chris. Chris, it's up to you.
Okay, thank you, Eusebio. But please, yeah, thank you. You are my lovely assistant now. Hi, everybody. I hope you can hear me. Could you just type a yes or a no, or type a yes that you could hear me? Just to make sure that I'm not broadcasting into the nothingness. And if you have any questions at all, please feel free to ask them in the GoToWebinar question area. Thanks, Robert and Sam and everybody else, Corny. And for the Maxes, just to let you know that our regular chat room is open if you want to ask any questions there. There's no password on it at the moment. Thanks, Terj. Okay, as you can see, I'm based in New Zealand here. And Craig, Eusebio and I have sort of been partners in this little venture since Jim died back in 2009. We were all on pretty much at the same courses in 2007, 2008. And this is the 56th set of Max courses that we've done. When Jim died, Eusebio took over the explanation of how the material actually operates. Jim had some brilliant ideas, and I'm still astounded at how well they work. But he wasn't the best at explaining them. He used to race ahead of the charts, get really excited, call everything pippies, and the mouse would not follow what he was trying to talk about at the same time. Thankfully, Eusebio was able to understand it and nut it out and put it together in a much more understandable form. And as a result, we're still, as you can see, changing and modifying the Max and adapting it to the situations. The Max itself is still pretty much the same as it was back then, but with ETF on top, it's now been turbocharged. And while we've had ETF for the last 2 or 3 years now, since Eusebio developed it, it's only now that we're bringing it down into the primer, the light, and the standard areas, so that you can take advantage of, so that you can actually trade in these much smaller ranges. In the old days, the ranges, as Eusebio was showing, was much bigger. We've had, when I look at the lists of people, we've got something nearly 2,000 members now, just a little short of it. We could be over it, we could be under it. It's a bit hard keeping track of all people's different email addresses. But it's just to give you an idea, been running nearly 10 years now, 2,000 members, done 56 sets of courses. We're pretty, the system works, we know what we're doing. There are people that are very successful with it. There are some people that are still struggling, of course. It requires commitment to this, just like Eusebio was saying. So next slide, please, Eusebio. And to help with that is something that's really important with training is the homework. And I consider it one of the most important part of the course. We could be training you in any method that's out there, but unless you actually know how to use it and have feedback that you are using it correctly, it's going to be of little help. So what we do is we ask you to draw up a chart. I'll show you an example of that. Send it into a group area, and the instructor, Eusebio or myself, will go through your chart pretty much bar by bar, analyzing it to figure out if you've done things correctly or not, and we'll send you the replies. This is so that we understand, well, it's more for your benefit, but a lot of the times you can get a hold of a concept and think that you've got it, but it's only when somebody from the outside checks to make sure that you actually understood it that you can be confirmed that you understand it. Trading is very much a black box type thing. You sit in a little room all on your own, you think you've done everything correctly, you get into the trade and it goes against you. And at that point you don't know if you did something wrong, you didn't understand something, or if it was just bad luck with the market. And by sending in the homework, we can, I know it's slower than live, but we can tell you if you've got the concepts correctly and that you're doing things properly. It also crystallizes any training that goes out. It's kind of like you get your hands dirty. You actually take it from the realms of, yeah, I know what she's talking about, to actually having to put it down on a piece of paper or on a chart. It crystallizes things. And when you're trading, with our practice sessions and with follow-ups, if you're getting stuck into some sort of area, you're most welcome to keep sending your charts into us to make sure that you're doing things correctly still. After a while, people tend to change what they think they understood. For instance, we can do training, and if people don't keep going over their notes, the information will change, and after a while people will tell us things that we taught them that we didn't teach them. Things get made up. It's just human nature. So next chart please, Eusebio. And one of the benefits of the homework is everybody sees everybody else's homework. So when we put up a few charts in the session itself, we can't cover every opportunity or possibility on the charts. People will send in different scenarios, and you'll be able to see how the max works in those different scenarios and how you would trade through those as well. So here's an example homework on the left. It's just a simple chart showing where the entry is, where you place your stop loss, all that sort of stuff, where your exits are, and then the instructor will go through that, like I said, bar by bar, and give you a response to it, tell you if your stop loss is in the wrong place. If a situation appears in it where there's something that's not been taught in the class yet, we'll make some sort of comment like, this is a ratchet, here's how it works, and probably bring it up in the next session. And everybody gets this benefit as well. So as well as the training, you also get to see everybody else's homework, and if you go through the homeworks, you can increase your training cycle or decrease your training cycle so that you're better equipped faster. Next slide please, Eusebio. Thanks. So here's a little table. It really needs to be updated now, showing what the course types are. What we have on offer today are two courses, the Primer and the Standard. The Primer is just an intro. It's like a demonstration course. It only runs for a couple of weeks. We've changed it. It only has ETF entries now. Trying to cram in all these classic standard entries as well as the ETF entries is too much hard work for just 2 weeks. So you still get plenty of entries with the ETF, counter trend as well as trend, but the light course now includes the standard, the classic entries. So the Primer course is just 2 weeks, the light course is 3 weeks and has a few more entries in it, and the Standard is our flagship. The Standard includes everything that's taught in the Primer and the light. So you can go straight to Standard if you want. Excuse me, getting all choked up here. But the Primer is there if you just want to test us out to see what it's like. I don't recommend it. The Standard is like a 7-week course. It is longer, but you get immersed in the information. What I've noticed when I've taught Primer, sorry, I'm an instructor for both of these, have been, when I've taught the standard, I can see that people get multiple looks at what the entries are like, taken through all the exits multiple times, and get to do multiple homeworks with it. So it really hammers the information in. With the primer, you get 1 week on entries, 1 week on exits. It's just a light brushing over. It's a profitable course, but it's much slower than the standard. There's no profit acceleration in it where there is in the standard. And as you can see, the profit increase when you're in the standard, if you get into a reasonable trend, something like 60 pips or more, or 40 pips or more, it just depends on what the action's like, you can increase your profits by 30%, even up to 300% at times, over what a simple get in and hold and exit type entry system would do. And because, well, not because of, in spite of our pyramiding, a lot of people think if you start adding orders to a trade, it becomes more and more risky as you go through the trade. The way we do it, the way Jim formulated it, it actually becomes much less risky very quickly. And I have some charts, but if you watch what happens on a regular trade, excuse me, early morning here in New Zealand, the standard course can become move into a guaranteed profit situation very rapidly, like within, say, a few bars, as opposed to another situation where it could be dozens of bars before you actually perhaps even come to a break-even situation. So the standard, counterintuitively, you become is less dangerous the more that you actually scale in. So it works. It's pretty amazing when you actually watch what happens with it. Not many people actually realize that. So we do tend to hammer the money management quite a bit. They both have homework. Like I said, the primer doesn't have as much. The standard has got 7 sets of homeworks, and they both, you'll be invited to the primer forum with the primer, and the standard course, you'll have the standard forum as well. And we have practice sessions each weekend that go on. We call them scrolling parties. We have different levels of the scrolling parties. So, for instance, tomorrow we have one for the bonus session for the standard course. We don't normally tell people, but with both of the primer and the standard course, we have an extra bonus class as well. And this is where Eusebio runs through 3 different scenarios, showing you what it looks like when you're in a losing trade, a winning trade, and in a choppy, how to trade in choppy conditions. And we've got videos of all of these, so you can go back over different examples and see how it actually pans out. Tomorrow, normally we hold these on Sundays, but tomorrow we're running the standard end of course session with Eusebio. So, and I'll be sending that information out to the standard people. So unfortunately, if you've only done primer, this week you get off, but the standard people get another practice session this week. So it's kind of how we operate. Once you've done standard, you're welcome to take advanced and SAM. SAM, as Eusebio was saying, lets you see the chart movements in finer detail and boost your profits remarkably again. But you need to do standard first, because all the exits and the entries in SAM are based on ETF standard. There's maybe a couple of extra as well, but you still need the standard as the basis. And the ETF advanced side of things teaches you more about the fundamentals. There are a few more entries and scaling techniques and ways of staying in a trade, but mostly it's on the fundamentals, currency correlations and stuff like that. So complete course. If you are not able to take the course live, because sometimes the world is not round, it's flat. Oh, sorry, the other way around. It's not flat, it's round. So there are actually different time zones around the world. If you can't make it, or if you're working or something like that, or you get sick, you get the videos and you'll be able to participate in the course from the video. If you do start the course and work or something knocks you out of the picture for a while, you just pick up once you've finished, keep sending in your homework. when you're finished. There's kind of no time limit on the courses when we do them. We're happy to carry on marking your homework months after the course itself is finished. Okay, thanks Eusebio. Next chart, please. Okay, and just so that you know, at the end of this course, we'll have one giveaway at least, and answer any questions that you have. And if you do have any questions, please pop them in the GoToWebinar area. This is where the heavy sales piece comes in. Just to wrap up, the courses, the Max courses, are very detailed and very precise. Because the ranges are so narrow these days, we will find a setup bar, and then on the next bar, or whenever the next good trigger bar occurs, within half a pip to say 2 or 3 pips, just depending on what the movement is like, we'll be executing, pulling the trigger on that. So on a 5-minute chart, you have to be quite detailed and precise. On higher time frames, you can take a bit more time, say 1 or 2 hours before you make up your mind, say on a daily chart. But nevertheless, the idea that the way you trade in the 5-minute chart is very similar, just multiplied out by time a little bit more on the higher time frame charts, just to take into account the different scaling. So we give precise setups and tell you exactly where you should be entering if it all turns out. If it doesn't turn out, sometimes you can get in on a trade and that very bar turns into a bad one. Then we have exit techniques to take you out straight away or very quickly thereafter. So the losses can be minimal, but the profits are quite large when you get into there, and the win rate is large as well. We use the MetaTrader platform for our training. This is because it's freely available everywhere. There's no data feed fees. It's reasonably easy to set up, and we've got little videos to help you get through it if you've not ever used it before, to show you how to put lines on the chart and how to enter the templates and the indicators. We supply all the indicators and the templates that you need, and you just put them into the right folders, load the template on your chart, and the chart's set up for you. There's not much more that you need to do on that. It also does screenshots, so there's no problems with the homework. All the course materials are provided once the session is finished, within like a few minutes to a few hours, depending on who your instructor is. So you get videos, the PDFs, notes, a chat transcript from it, because at the same time as we're training, you can ask questions of what's going on in the class itself. Yep, so there's no problem with that, and you'll be able to see what other people are asking at the same time. Okay, next slide please, Eusebio. Sorry, I should also say, while we train in MetaTrader, we have people that trade with different platforms. So some of them use MetaTrader as their charting platform, and then they go over to say Oanda or MB or Dukascopy and place their orders in those particular platforms based on the charts. And we also have indicators, not complete indicators, because we've now added another one, for NinjaTrader, TradeStation, multi-charts, Forex Tester. Yeah, as Max members have ported the indicators from MetaTrader to another platform, and we can supply the source code, there's no problems with that. Some of the members have said, hey, I'm giving back to the community, they're free to use these indicators. So thank you to those people that have done that, and they're available in the forum once you've finished the course. Okay, so there's no charge for that. Okay, as I said, the homework is really important. I think it's what distinguishes our course from most others out there. And I know very few other courses that do this kind of rigorous checking that we do. So this helps cement the information that you're given. It's not just a PDF or a video that you watch over once. We want you to do the homework so that we know that you actually understand what we're talking about, and so that you know that you understand what we're talking about. It verifies things for you. It stops the trading from sitting in a little black box wondering if you're doing things correctly to, yes, I'm doing things right, but something went wrong here. And like I said, we've got plenty of after-course follow-ups, so you can send your charts in to find out if you're actually doing something wrong or if it was the market, and we'll just feed you back. A lot of the times it's because people have not set things up properly, they've forgotten how an indicator works, they've forgotten about news events that are coming up, all those sorts of things, so we can sort of put people on the right spot. As I said, we've got a Max forum where there's plenty of videos, little training videos. We've got practice sessions on the weekends, the scrolling parties, and we've also got a couple of other things. Should update that. We've got a beastie called the News Watch List. This is for trend traders. If you're trading in a trend and a news comes out and it does something unexpected, you can lose your profits and you can also lose money out of your account. Two important piles of money. So what we want to do is not to trade through those pieces. And what Eusebio does each weekend, and I put it up on the website, is a list of important news events that are important to trend traders. If you're a news watch, did you want to bring it up, Eusebio? Cool. Okay, it's not been updated yet. I'll be doing that with Eusebio maybe after this or tomorrow. But here's a list of the various news items through the week. The red ones are really important. If there's good movements from those, you can make money from them. But generally we say don't trade through these. If you're in a trade, make sure your stop's really tight, that you got profit, or just close your trade and then start up afterwards. And the red ones are really nice because if you're not in a trade yet, well, any of them really, if you're not in a trade and the news comes out, then look for the news to actually see if it's caused some commotion so that you can get in on a nice movement. And a little bit further down from there is our top 10. It's actually 14 pairs. We sift through the 28 pairs, the 28 majors, and find all the pairs that have made, list at least the top 14 pairs, and from those, the ones that have made over $750 on average for the last 4 weeks per day. It's a bit messy, but like I said, the ranges are getting really tight. This time last year or maybe 2 years ago, the average daily range was up around $3,000. Now it's down to around $1,100. I thought it was getting a bit bigger, but just for the last 2 weeks, the ranges at the bottom end have really shrunk, and it's not even hitting our minimum dollar range. So we've only got 8 pairs for last week. This week there'll be 10 pairs. The range has widened a bit. Last week it was a bit small because of the holidays in the States, but things affect things all the time. So we try to keep you up to date with this. So if you want, you can subscribe to it or just keep checking it on the page. There's no charge for that. And we also, as another help for you, Eusebio puts together things called price levels, which show important levels in the market where price is likely to hit as a consolidation zone, support resistance, can be used as targets or take profit areas, or as stop losses if price goes against you. Sorry, Eusebio, can you flip back to the presentation? Thanks. And these are available. We have a paid subscription, about $50 a month for Eusebio produces 20 pairs a week. Levels for 20 pairs and a couple of indices and gold and oil. But we also have a free version of it as well, and we'll be putting out the links in our emails that we send you. You're welcome to join in, and you'll get a couple of those price levels each week for you to place on your charts. The way we've set them up is they work really well on MetaTrader charts. You just drop a template on your chart and a script, and it will automatically put the lines on whatever live charts you've got running. So you don't need to mess with your setups. We'll put the lines on for you. But that's only for a couple of indicators, just to give you an idea of what it's like. And there is also a little price levels course that Eusebio's put together so that you can do them yourself. And I recommend that you learn how to do it yourself rather than rely on other people, because we're not going to be around forever. Okay. times do the classes take? Okay, just a question that popped up. I'll get to that in a minute. So what we want to provide you with this is, with the primer, just a taste of what the standard is like. Like I said, it is profitable, but it's slow, and it requires a lot more patience and discipline than the standard does, simply because you have to sit there on your hands waiting for a good movement to come up. The standard has many more entries than the primer, a lot more exits, can scale in when the movement gets going, so you can maximize, really milk the trend once it gets going. And that's what the standard is all about. We want to give you a really good solid trading method. We will supply as much support as you ask. You have to ask. You drive us. We try and drive as much as possible, but there's always things that we're missing or something like that. The trading is not easy, so we want to support you as much as possible. And from what I've seen, the Max is one of the most powerful trading methods that's around for trend trading and now for counter trend trading. So gets you in, it's very precise. We have plenty of support. It's up to you to do the work though. And with the standard, you get plenty of opportunities to really hammer the information in. So in the end, you get to achieve your goals, like support yourself, become debt-free, watch out for your retirement. Just be aware that trading is not a get-rich-quick scheme. It does take time and effort to get into this, and it could take some people. In general, I'd say the median is around about 2 to 4 years to become consistent enough to be producing profits from this. I know it's probably not what I should be saying in a come and buy this situation, but don't get your hopes up too much. It's 50-50 if you're going to make money from the start, and that hooks a lot of people. It's like cocaine. But then they get hooked, and when they do start trading, they start making all these mistakes and don't know what's going on in the market and just lose account after account. We do everything we can to protect your account. So it does take time, but if you're really patient with it, and you have to be super patient with Primer, you can become profitable reasonably within a reasonable time. It's just like going to another job. You have to do the work. Okay, next slide, please, Eusebio. Now that I've gone like that. Hey, Jan, nice to see you again. Okay, so pricing, Max Standard or ETF Standard, now that we've added that, with all the profit acceleration, account protection, etc., starts this Friday on November the 3rd, New York time, at 4 p.m. So that's when we run all our courses, 4 p.m. New York time. And it runs for 7 weeks. And there's an 8th session as well when we can fit it in. So 8-session course. Normally it's priced at just under $3,000, but we have a webinar special today for $2,399, and Craig has made some payment plans available as well. So if you want to take it up, the link is at the bottom there, and just ask Craig, hey, tell me about the payment plans. Here's what I can do. He's also put together a training package deal with 3 courses. This is the Primer, the Light, and the Standard. And that would be Primer for probably do the first 2 by video with all the homework. So there's about a month's worth for each of those. So there's 2 months taking up Primer and Light, and then the Standard is another 2 months. So you get 4 months worth of training here, and plenty of homework, and you'll have the information hammered in really, really nicely. So if you want to take that up, again, that link will take you to the page that will let you subscribe to it. And like I said, if you can't make it live, we've got the videos for everything. Next page, please, Eusebio. Those are, Robert, all US dollars. So the pricing is in US dollars. Okay, and so this is the Primer. 2 sessions plus that extra bonus one. It's a very good start if you're new to trading, but like I said, it is quite slow. And one of the downsides of the Primer is you get a few entries, and you'll be sitting there on your hands most of the time. And what happens is if you have to be really disciplined, even more so than standard, like I keep saying, because the market openings won't be there. And because you sit there waiting, a lot of people will think, oh, I'm going to just get in here. And they start forcing trades or playing with the entry button and start making bad trades and lose their account. So the primer is more dangerous than the standard simply because we are more impatient in the primer. So be careful of that. But nevertheless, it runs for 2 sessions, full-blown, plenty of videos afterwards, everything available. The forum and the scrolling parties, not as many, but they're available as well. Regular price is $329 and the webinar special is $159. But if you're serious about trading, then this is just the entree. Well, sorry, Americans use entree in a different way to us, the rest of the world. This is the just a teaser, an appetizer, not, it's not the main course. And if you want to do just the primer and the light, then it's $759 for those 2. It's a price saving of about $300. And again, a slightly different URL at the bottom. Craig will put the links up in the chat area, and we'll be sending the links out by email as well. So what else? Okay, just checking up for the questions. So, okay, what we've got is the standard on sale, and if anybody wants to upgrade from primer to standard, just let Craig know and he'll work out what discount levels you've got, and because you've already taken the primer, etc., so that you can move up to the standard. It's a really nice movement, and okay, and so we've got the standard and the primer on offer today, and if you want to take them, that's great. We've had some questions come in, and generally what happens before each one of these courses is we ask people to fill in some forms. You may have seen them, and we've got the replies back, and I've got a list of them up here. And one of the questions that was asked, and please feel free to ask any questions in the chat room area as well. My question is, how do you handle the sorry, that's the wrong one. I would like to ask how to avoid going greedy. I started 3 times in the Forex, yet I end up losing my money because of it going out of limit when deciding the lot sizes. Eusebio, do you want to try and answer that one? How to avoid going greedy? Yeah.
Yes, sure, indeed. In fact, whenever you open a trade, you have a risk with that trade, the risk to have a losing trade, and so to lose money. And so one way to avoid being greedy is to decide once and for all what is the portion of your trading account you can afford to lose on one trade without feeling completely hurted with that loss. Or hurt, I don't know how to say in English. Sorry for my bad English, hurt by that loss. And so this is why when you hear some traders or so said professional traders telling you that you can take a 3%, 5%, 10% risk per trade, this is way, way too much. And this is ignoring the fact about the realities of trading. You can sustain losing trades. And the rule of the game is to survive that or these losing trades. And this is why you should never, never, ever have a risk larger than 2% per trade. Even 2%, personally, I consider it's too much. Personally, I use, depending on the market conditions, on the circumstances, a 0.5% or 1%, exceptionally 2%. This is the only way to feel comfortable when you are in a trade. You will have losing trade. You will have a lot of winning trade. A temptation not to fall in is to avoid being in a revenge mindset. After a losing trade, you will have another trade opportunity. So forget all closed trade. Consider each new trade as a new trade to consider independently of the past. And so avoiding to be greedy is to limit the risk you have to use on each trade.
Thanks, Eusebio. I'll just put my 2 cents in. Oh,
yeah.
Okay.
No, go on, Chris, because I think I believe what you are going to say about greediness.
Well, yeah, it goes back to when you first start out trading, your account is quite small and you want to build it up really quickly. And so there's a lot of psychological pressure to do that. And so the thing, as Eusebio was saying, that's going to kill your account is by trading too much. And initial traders want a large account, so they trade too much. So it's really hard when you first start out. You have to limit the amount of money that you put on the trade. You have to keep it really small. And the strange thing is, the larger your account gets, the less that you start actually risking on the trade as well. So you go, Eusebio.
Yeah, and there is one thing you should pay attention to. Either you don't understand or you don't perceive the concept of the risk per trade, in which case the max courses are a great ways to learn how to perceive a risk and how to limit the risk per trade. But there is something else. If you systematically have a mindset of trade revenge, because you want absolutely to be wrong in the market, to be right in the market, you have to ask yourself honestly, if you have lost a big amount of money up to now, don't you have the mindset of a gambler instead of a trader? And if you are overwhelmed by the gambling aspect of trading, perhaps the best and wise decision for you to take is to stop trading, simply. Trading is not gambling. Trading is a real professional activity, and so you have to take into account that risk aspect very, very seriously so.
Okay, this is how not to sell a course. I thought I did quite well, and then you're doing really well as well. Okay, another question. How do I, where is it one? Well, a lot of people have asked, my number one challenge is making profits. And making profits is spotting the direction correctly and to know when to enter and exit a trade. It's covered in the courses themselves, when to enter and exit. We teach the setups. And Eusebio's companion indicator that he was showing in his presentation helps you spot the direction. It cleans things up really, really well so that you stay on the right side of the trade. Eusebio, do you want to speak more to the bias indicator?
Yeah, I can show, for example, on my platform, I will take, for example, whatever the pair you want. Let's take, for example, the Euro-Yen, which is the pair I like to trade. And so we can see here what has happened yesterday. So look here. So let's consider the European session here. We had in this area up to that point even, one entire movement given by our bias indicator. And so you can see that in this area, the long-term bias has a tendency to reverse, but we get never a setup to go long here. And so we had to stay in the short trade. And so we have been able to catch that entire downtrend from that point approximately to that point, which was a movement of 100 pips. The previous day with the ECB, this was the ECB rates announcement, and then the press conference here. And so this point here was around 40-45 minutes after the beginning of the press conference. Everything was said during the press conference by Mario Draghi, and look at the trend was to the downside, way up to the bottom here. And so it was a nice movement to catch after the press conference, almost 100 pips movement. When you know better what is happening, it was even possible to catch the movement from here and to stay in the news here. We don't advise to trade during the news. Preferably, we will close the trade before. But when we understand what is happening and what are the constraints of a central bank, it is even possible to catch the movement here on this point, so right here, and to take that entire movement, staying even in that deeper pullback the price was making. Of course, when the price is choppy during the Asian session with a pair like the euro yen, so we can trade it. For example, here, this movement was an up movement, so it was possible to trade that movement. It was a movement of around 18 pips. Day after day, we have that nice down movement given by our directional bias here, an up movement with all that movement, and then here a small up movement here, and so on and so on. Every day, look at that down movement here, and then that up movement way from the bottom, so the previous day. And so every day we have, with the max standard, many real nice trade and nice trend we can catch. Look here again, that nice up movement, and so on and so on. Look here, that nice up movement, that nice down movement. Of course, when we have news, we avoid to trade. Look here again, an upward movement starting from here and staying in the movement up to that point. So a nice up movement of approximately, so here 96 pips with one or several scaling. You can see also on the chart, let's go back to the end of the chart, what Chris was explaining. So here price levels. These are price levels I produce every weekend, and you see how the price nicely respect these levels. And sometimes the price crosses through these levels. But look here, look here, look here. They really help to stay on the right side of the trade, and so on and so on. And so we have rules to tell us exactly when a directional movement starts and when a directional movement ends. Yes, Chris, please.
Okay, I was just sorting through some more questions. People want to know how to stay consistent to maximize winning loss. Sorry, it's a bit hard to read some of these questions. How to stay consistent to keep maximum win-loss ratio, winning percentage, and low drawdown year after year, even during unexpected financial events like the Black Swan event with the Swiss.
Yeah, the Swiss is a nice example. It happens in January 2015 or 16, if I remember correctly.
Yeah.
And the announcement has been made for the London Open, by the Swiss National Bank. Fortunately for the max trader, but I agree this was by luck, at 9:30, so half an hour later, there was a very important news release. And the rule for us is, if we have, let's take for example here, let's take Friday here, Thursday with the ECB. So at this point we had a news release, okay? We consider 1 hour earlier. And so 1 hour will be, I don't know exactly which candle, but if we are in a trade and we are facing a very important news release, so half an hour before the news release, we close the trade. If we have no trades and we have a setup appearing, we can take the trade provided we have more than 1 hour before the news release. And following these two simple rules, we have been able to avoid many of the black swan, especially that with the Swiss National Bank, because we were in the windows of exactly half an hour. And by the way, for the London Open, we always advise, if we have a setup appearing just before the London Open, wait for the London Open, because we have an increase in the volatility which can create some pullbacks against the trade you consider to open. Between the Frankfurt Open and the London Open, we have many head fakes. And so that it was a nice way to avoid that Swiss National Bank. Another way to avoid the devastating effect of black swan, because we cannot avoid all of them, is precisely to use a small risk per trade. If you use a small risk per trade, you will have a high chance to survive the black swan. And this is why it's important to to understand what may happen. In the case of the Swiss National Bank, another way to avoid that event is it's always dangerous to trade a currency which is pegged to another, because the pegging of that currency to another may be relieved at any moment, because the prices are then artificial, and so never trade a pegged currency. That's an important rule too.
Okay, thanks, Eusebio. Another question that's come in is, well, okay, sorry, something while you were talking is all of our trades use a stop loss. We have it.
Yes.
When we place an order, we place in a hard stop loss. It's not to protect the profits, but it's to protect your account, because a lot of times the internet connection can drop out, your PC might blow up, your hard drive might fail, you might be called out of the house or something like that. All sorts of things like that can happen so that you no longer have access to your trading platform. And if you've got a hard stop there, then you'll be taken out of the trade without losing too much. I was reading just recently on Forex Factory some people talking about the uses of stop losses and how it's silly to actually put them on your trades. And if I just don't understand how they're thinking. People were saying that they're advising not to use a stop loss. It was like they didn't understand that it's there for their protection, not to take profit from their orders or anything like that. We have a stop loss to protect the account, and then we have lots of different exit techniques, over 20 in the standard course, to actually protect your profits. And if you look at if you remember some of the charts that Eusebio went through, we're getting out almost at the end of the movements themselves. This is where our mental stops, or our mental stops is the best way to do it. All the indicators and the price patterns and stuff like that tell us where the trend looks like it's about to end, and much of the time we can exit at a really nice spot. But if sorry, go Eusebio.
Yeah. In fact, to be a little more detailed, in our exit techniques, we have short-term exit techniques and we have medium, long-term exit techniques. The short-term exit techniques have the aim to bank some profit, which is an important component in the trade risk management. They correspond to our MXs. And the medium or long-term exit techniques have the aim to close the trade, because the trend is exhausting, and we have several ways to observe that the trend is exhausting. And that way, we avoid to close the trade on the stop loss, even if the stop loss is adjusted along the trade. We want to optimize the profit we can catch from a trade. But we want still to protect our account in the case things goes wrong with our trades. And the problem with many people not understanding the role of stop loss and not accepting the losses is they want to be right in the market. And the problem is the point is never to be right or wrong in a trade. But the point is, when you are right, you make more profit than the losses when you are wrong. If you understand that, then you increase your odds to become profitable in the market. You have to accept your losses. And in that point, don't be misled by a high winning rate. A high winning rate is never a guarantee to be profitable. I can show you trading system having only a 20% winning rate, but being extremely profitable. And I can show you trading system having a 90, 95, 99% winning rate and failing miserably. So the winning rate is not important. The expectancy and the frequency of the trades are way, way more important. So don't try to be right. What is important is to make more profits when you are right than the losses when you are wrong, and accept and embrace your losses, just as a way to improve your trading techniques. Yes, Chris.
Okay, thank you. So just a couple more questions left. I'm going to compress these two. One person has said, I'm still exploring trading. There's so much clutter with mutually contradictory information. And this is what triggered my stop loss versus people not wanting a stop loss. So there's so much clutter with contradictory information that it practically becomes impossible to get the right information with confidence. And the other person has said, I try following the taught strategy, but strategies keep failing me. So I try another strategy and another, but I've fallen into a black hole and I don't know how to get out. Help. So do you want to have a go at that one, Eusebio?
Yeah. There are many strategies which are taught by traders or sometimes only marketers, unfortunately. But there are also good strategies. The problem is many traders want the easiest way to trade, and they focus only on one aspect of the trading system they are using or they attempt to use. I have said that with the MAX focuses on three aspects. The technical aspect, which is what you are seeing on the chart through indicators, for example, the risk aspect and the global context aspect. And for me, the main aspect to be successful in trading is to understand the global context. What is happening around the world which make easier to understand how to trade. For example, why in the top 14 pairs I have shown previously and Chris has explained, we have many pound pairs. Of course, this is because of the Brexit problems with UK. And why do we see sometimes nice up movement and nice down movement on the pound pairs? Because of the events happening in UK. Whenever you have the Prime Minister, when you have an important politician speaking good or bad on the pound, this has a direct effect on the pound and the pound pairs. When you have an important news release on the pound, this has a direct effect because there are a lot of expectations by traders about the future of the economy in UK once the Brexit will be over. So once you understand that aspect, you better understand the risk you may have in trading pairs containing the pounds. But this is similar with any other currency. There is always something to understand in order to know why the market is moving the way it is moving. And so the fundamentals aspects are important. The micro and macro fundamental aspects are important. It's not only a matter of indicator telling you when to buy, when to sell. If you focus only on indicators, you will fail.
Okay. And I've been kind of thinking about this because there's lots of different indicators and lots of different strategies out there. One of the important things is pick one and stick with it. Don't jump around.
And by the way, it's not an indicator which is important. It's the relationship between the price behavior and that indicator behavior. Why is our bias directional indicator working so well? It's because we don't consider to go long when the bias indicator reverses. There are other conditions we have to take. For example, here, you see the bias indicator is changing here on this point. Right here, okay, on this point. And I'm going to draw a vertical line, I've said here, in this area. But we will not take a trade before this point, and this point will give a losing trade. And then the next attempt will be here. And this will be also a losing trade. And then the third trade will be here, and this will be the winning trade. And so it's not because a trend reverses through an indicator that you will have necessarily a nice trade. You will have losing trades, and you have to deal with it. Okay?
Okay. And as Eusebio said earlier, you could have multiple losing trades in a row, and it doesn't mean the strategy is bad. But if you are, so stick with it. But if with the MAX, if you're having that sort of hassle, you can send your charts in to see if it is just the way that the market's operating at the time, because sometimes it can be really choppy and surprise you, and other times you may have noticed that it wasn't a choppy mode and you shouldn't be trading during that period, and we can help you out with that. The other thing is there are a lot of different strategies out there, even though there's only just one price for the US yen at any one time. And I was thinking, if you look at the night sky, if you're able to see it these days, you'll see all the stars up there. You can look at it with a infrared filter or an ultraviolet or radio or just plain light, and you'll get different patterns coming out of the sky. You can see that if you just search the web. So, and you can become an expert in your various particular wavelength. Doesn't mean that anybody else's is wrong or right. It's just that you become the expert in what you're doing. So you've got to stick with it. You can't sort of mix and match them. You've got to pick one and stay with it. Okay, what else?
Yeah, and in that context, by the way, Chris, the lagging aspect of indicator doesn't matter at all. This is a wrong myth, which say that a lagging indicator is worthless. This is not true. The lagging part of an indicator is not the most important aspect of using an indicator. But as I have said, an indicator is just there to help you to pinpoint faster when you may have possibly something to observe on the chart. Possibly, and this is important, possibly.
Yeah, they're called indicators, not take action things, whatever that word is. Okay, I think we're about done with the questions here. If you have any others, please put them into the...
There was one asked by Abbas. I hope I'm pronouncing your first name correctly, Abbas. If we have an automated tool for an automated version for the MAX ETF. No, we don't have. The MAX is a manual trading system, but with the introduction of the ETF concept, we have some perspective that in the future we may have an automated trading assistant, not to fully automate the trading, because fully automating trading system is not possible due to the global context, but at least to have a large portion of the process being automated, then driven by the trader. But it's not for now, it's for the future. But we have that perspective now.
Okay. Right. So just getting back to the sales side of things, thank you very much for coming along here. If you want to take the standard, then the pricing is up there and the links have been put into the chat area. We'll leave and if you just want to try us out, see what we're like, but I think you've got a reasonable idea from our speaking right now. If you can take the primer course, and like I said, the links are in the chat area and they will be sent to you by email as well. And yeah, thank you. It looks like there's no more questions. So thank you very much, everybody, for your attendance. Much appreciated, and hope to see you in a class shortly. Bye now.
And if you have further questions, feel free to send an email to this email address I have been pointed on the PDF. So, or you can send also your email directly to Craig at maxtrades4u the number 4u at gmail.com, as he has mentioned in the chat area of GoToWebinar. So thank you very much for your participation and see you in the courses. Bye everyone.